Hey, welcome. Have you ever looked at the news, seen that interest rates are way higher in another country, and had that little thought, huh, why didn't I just park my money over there and make a killing? I mean, it seems so simple, right? Like an obvious, easy profit? But here's the thing about global finance. If something looks like free money, you can bet there's a catch hiding somewhere. And that very question, that simple idea, really gets to the absolute heart of how trillions of dollars flash across the globe every single day. The answer isn't just a quick no. It actually reveals one of the fundamental rules that keeps the whole global financial system from spinning out of control. So, the answer lies in one of the most powerful ideas in all of finance, the no free lunch rule. See, the global market is like a giant, super efficient machine that's constantly hunting for these easy, risk-free profit opportunities, what we call arbitrage. And as soon as it finds them, it stamps them out. Now, this whole principle has a formal name, of course. It's called interest rate parity, or just IRP for short. And you can think of it as this crucial bridge that connects two absolutely massive markets, the world of interest rates and the world of foreign currency exchange. It's basically the math that explains why that free lunch just vanishes into thin air. And this quote? It just nails it. It perfectly captures what IRP is all about. This isn't just some dusty theory from a textbook. No. This is the market's own logic working in real time, making sure that once you factor in the cost of changing currencies, the return you get on an investment is pretty much the same no matter where you are in the world. Okay, so here's where it gets even more interesting. IRP isn't just one single rigid thing. It actually comes in two main flavors. One is an absolute cornerstone of how big companies manage their money, and the other is more like the foundation for some seriously high-stakes bets on currencies. And this table really lays out the difference perfectly. On one side, you have covered interest parity, or CIP. This is the safe path. You use something called a forward contract to lock in your future exchange rate right now, which gets rid of all the currency risk. It's a rock-solid pricing rule. On the other side, you've got uncovered interest parity, or UIP. Now, this is a total gamble. You don't lock anything in, you're just betting, hoping that the exchange rate will go your way. It's all based on what you expect to happen. And because of that, in the real world, it fails a lot. All right, enough theory, let's make this real. We're going to grab some actual market data and walk through the numbers to see exactly how this whole free money opportunity gets erased by covered interest parity. Okay, here are the ingredients for our little experiment, all based on real CME Group data for a 91-day period. First, the spot exchange rate. €1 gets you about 1.08 US dollars. Next, the interest rates. In the Eurozone, it's about 3.4%, but over in the US, it's way higher, over 5.1%. And that, right there, is the temptation. You see that higher US rate and you want to chase it. So here's the game plan. We're going to run two parallel investments. We'll take our €1 and its dollar equivalent, and we'll invest each one in its own home market. Then we'll see what they're both worth in 91 days and figure out the exact exchange rate that makes those two final piles of money equal. First step, the euro. Pretty simple. After 91 days earning that 3.4175% interest, our single euro grows into this, 1.00864 euros. Easy enough. At the exact same time, the US dollar equivalent we started with, invested at that much juicier 5.1550% rate, grows to about $1.09. And here it is. This is the absolute key. For there to be no free lunch, the market has to make sure that 91 days from now, our future pile of euros is worth the exact same amount as our future pile of dollars. They have to be equal. So how in the world does the market do that? It's all about the forward exchange rate. When we divide our future dollar amount by our future euro amount, we get this number, 1.08425. Now notice something? It's higher than the spot rate we started with, and that is not an accident. That increase in the exchange rate is the exact amount needed to perfectly cancel out the extra profit you thought you were going to make from that higher US interest rate. Poof, the free lunch is gone. But you knew there was a but coming, right? Of course, the real world is messy. It's never quite as clean and perfect as a mathematical formula. And sometimes the theory has to bend a little under the pressures of the real market. In reality, you've got all these different frictions, things like funding shortages in one currency, different regulations, or just massive supply and demand imbalances. And all these things can throw a wrench into the gears of our perfect covered interest parity model, causing these tiny little cracks to appear. This deviation, this little crack, is so important that it actually has its own name, the cross-currency basis. You can think of it as the real-world price of those market frictions, the true cost of doing business. And let me tell you, professionals watch this number like a hawk, because it can be an early warning sign of stress building up in the global financial system. Let's go back to our data for a second. The actual observable price in the real market to swap euros for dollars in the future, it wasn't exactly what our perfect formula predicted. Our math told us the difference should be 47 pips, but the market rate was actually 49 pips. And a pip is just the tiniest little move an exchange rate can make. We're talking about the fourth decimal place here. That tiny 2-pip difference is the cross-currency basis. And when you do the math to translate that back into interest rate terms, it means the market was effectively saying that borrowing euros was about 7.3 basis points more expensive than the official rate implied. And a basis point is just 1/100%. This is it. This is the real-world friction priced right into the market for everyone to see. Okay, so we've thrown a bunch of math at you. Some weird terms like pips and basis. Why should any of this actually matter to you? Well, because this isn't just some theoretical puzzle. This is the engine room of global business. You see, this whole principle is a fundamental tool for any multinational company that has to deal with different currencies. It's what they use to price contracts for the future, to figure out if it's cheaper to borrow money in dollars or yen or euros, and to build their entire financial strategy with a lot more certainty. Now, what it's not for is trying to guess short-term currency swings or guaranteeing a profit. In fact, its entire purpose is to do the opposite, to eliminate those guaranteed risk-free profits. And that leaves us with this final, really fascinating question. Imagine you're the CFO of a giant global company. You know these tools exist. You know you can lock in a future price and completely eliminate your currency risk. So, when, if ever, does it make sense to say no thanks to that certainty and just take the risk? That isn't just an academic thought experiment. That's a billion-dollar decision that people in boardrooms around the world have to wrestle with every single day.